Okay, so we have still got a couple of people joining, but we'll go ahead and make a start. So welcome to our Q2 review for CBAM, Portfolio Performance Review and Outlook. We've got Sam with us today to run through his presentation. As usual, we will have a Q&A section at the end for those of you who have got any questions for Sam, or you've got anything that you'd like clarified throughout his presentation. Just use that Q&A box to the right hand side and we can get through to those at the end. Otherwise, Sam, I will leave you to it.
Many thanks, Jess, for the introduction, and good morning, everyone. Thank you for joining me this morning. We are now over the hump of the middle of 2025, so after what was quite an eventful first half of the year, we look forward to what should be a little bit of a quieter summer period before heading into the more busy second part, the busier part of the second part of the year, typically after everyone comes back from their holidays. Just going over what we'll cover today. Unfortunately, Mark isn't able to join me this morning. He's been called to other business. So you are left me. I've been a portfolio co-manager now within Cape Berkshire since the end of 2023, but within the wider team since 2017, I want to say, so not awfully far off of 10 years now. And yes, been adding my influence a little bit more over more recent years, but still under the stewardship of Mark there, who I'm sure most of you are familiar with. Got to go through the important notices as we do every single quarter. This presentation is literally for information purposes, just to give existing clients an overview of how we have handled 2025 so far, but also some of our ideas moving forward. Cape Berkshire Asset Management, as you may hear us refer to, is actually a trading name of Cape Berkshire Limited, who are appointed representative of Ascot Wealth Management, and we are both authorised and regulated by the FCA. These investments are not suitable for everyone, but then that's why, of course, you go through your financial advisor. We do have the annual management charges, which are 0.35% per annum on the P portfolios and 0.2% per annum on the R portfolios. Cape Berkshire doesn't offer tax advice, etc., but tax legislation surrounding investments may change in the future. But again, that's where you go through your financial advisor. And of course, investments are not risk-free. They can rise and fall more than other investments. However, you can get back less than you originally invested. Change your words on that, actually, because I'm not sure I quite agree on that last point. So just going over what we're going to go look at today. So we'll take a look back over the second quarter of this year and have a look as well at how we have been acting throughout that quarter. Obviously, it's been quite a newsworthy quarter, so we have been quite active. Then wanted to go have a look, as you know, I have done for a year or so now, been looking at under the hood, so looking at particular holdings that we have in the portfolio, do a little bit more deep dive why we hold them. Want to do a little bit of a previous one that we've done, just to show that our premise for why we held it and how it's delivered since then. Then let's have another look at what I did in the last quarter, which is the where to for 2025, and seeing how those scenarios are kind of working out there. Finally, looking at the portfolio positioning, I see we have some people today joining on mobile devices. The table is probably not best used on a mobile device, but I try to explain through it best as I can. And then obviously, if we have questions, well, throw in your questions at any time. But if I get around to answering them at the end, that will be it. So first of all, of course, looking at over the quarter. So on the whole, we've done pretty well. You know, any quarter value could be up 5%, up to 5%, is certainly a very good quarter indeed. Of course, that comes off the back of a a little bit of a disappointing first quarter, where we were having a bit of a rotation out from the Magnificent Seven tech stocks in the US, and was having a little bit of a worries in the build up to what the tariff wars news might have been. It seems ages ago now, but that was actually in this last quarter just gone. So we were kind of coming back off that negativity, but we have certainly dealt with that April very, very well indeed. We went into that last quarter quite cautious, took quite a bit of risk out of the portfolios in anticipation of those tariff announcements, and then when the opportunities arise, we started to put that back into the portfolios, and we can see the difference there on how we perform versus benchmarks. So our internal benchmark, which the more we look at other external benchmarks, we realize the internal benchmark, which we refer to, is actually a very difficult benchmark to beat. So very happy that we have outperformed that by quite some margin. Only one portfolio failed to beat that last quarter. However, as you can see, it was down 0.01% in comparison, so pretty much flat in comparison to benchmark. We looked at the ARC NPS benchmark, so that's an external benchmark of other model portfolio providers. We see very, very healthy performance there compared to external benchmarks and other competitors. On average, they're up to 1.38% ahead on the quarter, as little as 0.26% ahead on the quarter. So very, very healthy numbers indeed. But looking at how it compares, bringing that the whole year so far, the ARC portfolios did struggle in the first quarter off the back of procedural limitations. So I wasn't able to be, sorry, the team to be as dynamic as we would have liked to have been in how we could help protect from the rotation away from the Magnificent Seven at the beginning of the year. We hold passive funds where possible in the ARC portfolios. So as a result, a high concentration there within the Magnificent Seven, and obviously US makes up a very, very proportion of equities from the portfolio. But also we weren't able to implement our bond active holdings. So that's one thing that really helped the P1 portfolio, for example, and that's why we ended up with quite a spread there over the year to date. But as you can see, we're up to, on the P5 portfolio, up to 1.74% ahead of benchmark there for the year so far. So very healthy indeed. And then if we compare to the wider external benchmark there, we see that we are not far off on the P5 portfolio, nearly 3% ahead there in 6 months, which is fantastic. But everything apart from R1 there ahead of our external competitors. So we're very, very happy with that indeed. And so far for the year to date, we've made up those little bit of wobbles at the beginning of the year to be really, really positive, to be round about 4% ahead on the P portfolios through half a year is, I think, is very good indeed. VR portfolios there for half a year, you know, they all begin with 2, but they're high 2s, and they are trading where we would expect on what is proved to be a good year thus far. But I want to talk very quickly about Q3 in conjunction with Q2. So I know it's only been 2 months, but just to show what an amazing July we are thus having. You know, R5 there is delivered 3% so far in just the last 2 and a bit weeks. So, you know, we're having a really strong July so far. All portfolios up ahead. And we can see this being very, very positive generally indeed. The lower down portfolios are a little bit behind. That's because we think that some of the more higher yield credit space has got quite expensive. So we've removed a little bit of that there, but it's continued to rally a little bit. But I really don't think this is sustainable over a longer period. More than happy to throw graphs to people who want to understand my rationale on that. It's I've been told to tried not to throw too many graphs, etc., onto these calls, but more than happy to throw these things out there to people who want to know. But yeah, rather good. And then if we look at just how we've done since, just over the last 18 months there, I think the figures are talking rather well there. The R5, so it's not just, I know P's had a great 2025, but last year R was doing great. You look at R5 there, over the last just a smidge over 18 months, is nearly 10% ahead of the external NPS benchmark. So we're really, really happy with that. All of the portfolios are green across both sets of benchmarks there. Yeah, just really, really good generally. We're really happy with what we've delivered there for clients. But of course, that's the past. Very much wanting to see how we move forward from here. And we'll get onto that in a minute. I wanted to talk about this slide in a slightly different way this quarter. So if I could just draw attention down to the bottom right-hand side there. Sorry, this is the first of a couple of slides that would be a little bit more difficult for those on mobile devices. So the bottom right there is the top and bottom performing funds in our portfolios over the last 3 months. So these are the kind of the areas that, thank you, Jess. So these are the kind of the portfolios here that they stick very much more to passives, and it's more about how we do the sectoral allocations. We see there that we're moving away from the US exception. It's been very much that European story has continued out there. And I'd say even that the UK as well, the valuation metrics have improved for the UK. So that's hence why the FTSE 250 has had such a great 3 months there. There is a fund that we are currently looking at, which an active fund for P, which is performing excellently at present. I just need to understand with a meeting with a fund manager to understand whether it is sustainable. But at the moment, really happy with that kind of space there with how our sectoral allocation has been going there. And then if we go across over onto the P, just trying to move bits around on. I seem to. Sorry, Jess, could you just slide a bit further? Just zoom in a little bit further and move up a tiny bit. Sorry, zoom out a tiny. Oh, hang on, I just found the button. That helps. So if we look across one slide onto the P's there, what's really great to see is that, yes, I was saying that Europe has had a great quarter there with the passive holding returning 6.79%. Our active holding has more than doubled. So, and we're really, really happy with the return that manager's given us. It's a really, really good philosophy with how they look at it. So it's a value orientated strategy. So they are looking for for companies that are undervalued relative to their earnings. And I say that that's different to other value kind of funds. So they don't just look at that by isolation. They're looking for the possibility of upwards earning revisions, so what the market is expecting, and quite a few other factors. So they're not a pure value fund, but they tend to operate very well in this kind of environment, and that's very good. In terms also of active things that work well, although this is an index fund, it's the currency hedged version of the S&P 500 US. So the dollar has weakened a little bit over the last, well, certainly for the year in total, but in quarter three it had done somewhat. At one point we were looking at sterling being $1.38, which obviously if you go back 2 and a bit years, we were looking at $1.10 at one point. So that helps our us add extra value there. And also, you know, we've got two more active funds here, you know, that are overdeveloping. So the second highest returning R fund, oh, sorry, I think my connection nearly dropped out there. Second highest returning R fund, you know, returned 7.82. Well, that's around about the same as fifth highest returning P. So our active funds have been really helping to elevate lately. So I think that's been really good. And if you look again at what happened on the 1 month, this is continuing. It's proven to be a nice environment to be in on the active space at the moment. But the R's are still, you know, they're still performing well, and that's a sign that we're also getting the sector allocation right, not just the funds that we're picking within the sector. So really, really happy with that there. Let me move on. So busy month, a busy quarter even, of course, with the tariff news. We've also had the to and fro as what's going on with Ukraine. China has been performing very nicely in terms of its economic growth, so that's been good. And also there's been a couple of factors around the UK which I think have been helpful as well. This is the first time I've ever had to spread this over 3 slides. We've been very active indeed. So, as I said, we were quite cautious going into the tariff news. That was, I think, the 2nd of April. So off the back of that, when that news hit, just proved on the following days afterwards, just a really good time to start to move into more risk. So you're seeing here some of our kind of more risk hedges, let's say, within the fund. So for sovereign bonds, we were selling out of these through the quarter. Sorry, in the immediate aftermath of that news, and buying into a little bit more risk. So adding some high yield debt at that point, as it had got quite a bit cheaper to where it was about 2 months prior. Adding some mid-cap US, as the valuation metrics of that got particularly affected. And then also pivoting a bit away from gilts and topping up US government bonds, as we had heavily favored instead of US debt, as we were a bit nervous as to what's going on with deficits in the US. Obviously that still continues, but tariff news generally is positive for that kind of space. Obviously there's increased revenues to the government, which helps, you know, pay down debts, etc., or help debts not accrue quite so fast in the present case. June was an incredibly busy month for trades. Instead of going through each one of these, I'll talk a bit more broadly. So we had been conducting a review into our active holdings, and there were a couple that we'd held for a bit of time. Typically we don't like holding active funds in the US space, just because information and analyst coverage in the US is so intense. It's very difficult for an active manager over a long period to outperform a passive tracker. There were a couple of funds that we had held that looked like they were probably going to be a little bit better. They were looking at very incremental gains, and very, very similar in process. We split into 2 very similar ones, so that we didn't, you know, have all our eggs in one basket, so to speak. And we found that although probably does work on paper, we're not so sure it works in practice. So the JPM US Research Enhanced, as well as the Structured Research Equity Fund, have sold both of these to move into their passive equivalents. And the Equity Income Fund the US, that was a play off of the difference between growth and value styles in the US have become quite extreme, and that was a play to see that kind of spread narrowing, and that worked. So I was moving that again into the US. However, we have, as I've obviously been speaking about, active funds that have been working incredibly well. So, for example, in emerging markets and in Europe, we've been holding the Artemis Smart Gap range there, and what we find is that active works an awful lot better in these markets because the analyst coverage is not as intense, particularly in emerging markets. So as a result there, although we've moved from more active into more passive in the US, we've done the inverse in those other two areas. I'm glad to say that's continuing to work really, really well there. And again, Japan, another one of those places where there's a very clear story going on at the moment that you won't necessarily get out of on a passive fund. However, a good active fund will capture that. There's very good governance reforms going through in Japan. They're reducing, so an awful lot of Japan, you may or may not be aware of, the companies owned each other and they weren't particularly awfully bothered about how they utilize cash within the business. There was an awful lot of companies in Japan that held so much cash within their business. They held more than twice the value of the business in cash. So these reforms have been going on to enhance that, and the Nomura Fund's been really, really good at capturing these companies that are reforming far quicker, and therefore we increased our active over passive elements there. And then there was another bit more towards the end of last month. My head still wants it to be June. So we've moved from money market into the Royal London Diversified Asset-Backed Securities. So as the expectations, obviously, of where central bank policy rates are coming down, although they're holding still probably for the next 2-3 months. Still, we'll probably find as we go into 2026, they'll start to come back down again. Wanted to kind of get ahead of the curve there, and the diversified asset-backed securities is short duration, very top level bank notes that are secured. So they aren't very exposed to credit events, market things, but they have an increased yield over and above a money market. So over a longer period, we would expect that to perform better. So it's time for that to rotate back in favor of the asset-backed securities. We also sold out of the high yield position that I mentioned that we went to back again in April, just because we see high yield is again very expensive, and we moved that into a new fund, which is the Credit Opportunities Alternative, which aims to be a bit more agnostic with what goes on with these valuation trends in space. So that will as you can see, very, very active. Oops, said Q1. Of course, it's QT, but very, very active quarter. So looking at the Man GLG Sterling Corporate Bond Fund, as I mentioned, there's different areas that are covered more or less intensely by analysts, and the UK market, particularly when it comes to sterling fixed income, is becoming less and less covered, which means that your opportunities for an active manager increase more. They have a really, really good, clear process, which is they're looking for they basically screen the market to find the companies that are there are holes in the amount of analyst coverage, and it's not just that. Banks don't tend to cover companies that issue smaller bond issuances, because obviously it needs to be worth their time, and there tend to be their funds that they're managing tend to be very large indeed. So a small issuance just doesn't make a huge difference. Then it's not worth their time. Whereas because this is a smaller fund, they really enjoy those kind of areas. So as a result, they can look far more active and go, okay, but there's value very much here or isn't here. And they can afford to go into that and wait for others to notice what they've already noticed, as ultimately analysts will get round to that company, but it takes them a lot longer. So these guys are a lot quicker in going in there. The fund manager has a great track record before this fund, so he's been managing this fund now, I want to say, for just over 2 years. However, he has a previous track record at Schroders, which was very, very positive as well. So we went to this early January last year, and we've been very happy with it since. I think that says it all, really. The red line there is this fund. The green line is the for active funds and passive funds, actually. So as funds in general within the sterling corporate bond space. And the blue line there is the passive equivalent. So since we've held this in mid-January, it's returned to just short of 21%. Whereas the passive equivalent has returned just over 6% there. So in portfolios in the P portfolios, well, actually both portfolios hold down and lower down the more risk-averse portfolios, so your ones and your twos, hold an awful lot of sterling investment-grade debts. That is kind of like their highest holding if you look at the top 10s. So the fact that we have this in here and it's been performing so well and consistently as well, this has added awfully to the performance of the portfolio. So we're really, really happy with this one. One thing I did look at before I jumped onto this call was I looked at the ratios going on here. And one thing I noticed is that since we have held this, is that the any drawdown that occurred have typically been a far smaller percentage than the index. So, there's been less downside risk there, but obviously it's performing nicely upwards. And also it's less volatile day to day as well. So that also helps with the appropriateness of this within the lower down portfolio. So that's been really nice. So I produced the next slide for the last webinar. And when I was going through this, I was tempted initially to rewrite it. However, what I then noticed is that our cases have not really changed in the last 3 months there. It's been more of a case of working with the market fundamentals with regards to valuation metrics and making sure things don't get too expensive or pivoting to where we think places have got value. But our wider thoughts as to what's going on with the market have not awfully changed in the last 3 months. So if I just walk through, sorry, people on mobile devices. Can I walk? No, I didn't mean to do that. Jess, is there a way to drag around on this, or can you just zoom in and that's it? I think it is. You can just zoom in. Okay. So I tried to talk through this for those people. who are on mobile devices. So up top there, we're talking about US inflation. Still very much have a degree of caution within that. US inflation is still a little bit on its downward path. However, it's just started to pick up. So the way the tariff measures are at the moment is that we are likely to add around 1% onto CPI by the end of 2020. It's whether what's the concern there is if you also get a slowdown in economic growth as well, and then you start getting a bit more stagflation, that could prove a little bit more cautious. However, if we get more of these, if you get the US EU to have their agreement, which, if I'm honest, looks like the big one that has been a real tricky sticking point, I think we'll be looking towards a little bit more of the favourable case there. Energy prices aren't going up through the roof. Don't get me wrong, they do move up and down, plus minus $10, but they do tend to stick within that $70 to $60 kind of range there. So that's not too bad. And US GDP, base case there, slowing real GDP to the low 1% range. I think that's quite possible, possibly a little bit more there. The consumer squeeze likely to restart due to tariff wars. I think that might be quite likely to occur. And increased construction due to tariff wars. Obviously, if you're shoring and wanted to manufacture more in the US, you are going to see a bit more construction going on in the US, which you may find that construction material costs start to pick up, which is why we're looking at the moment at natural resource funds to see if we can get a little bit of exposure to that. UK GDP, steady as she goes. After the last week or so of news, it feels kind of about right. Although we had a bit of a surprise May figure saying that we've had 2 months of marginal, and I use that word in bold, marginal contraction. I think that overall we are looking at real GDP growth for the year in the UK at around 1%. Real earnings growth is still positive there. I think we might be starting to see a degree of increased consumer spending. I'm not sure how well placed that is, but and a little bit more productivity growth from AI and services. Obviously, the UK is very service industry orientated, so AI could have quite a big impact there in terms of GDP growth. So that's kind of the big ones there. When we're looking at say infrastructure there, we are seeing that increased US inflation will result in increased earnings with infrastructure. They have inflation-linked contracts, which is good, which is to even if we end up with US 10-year debt yield moving up a bit, it's likely to make up for that. So infrastructure could be a really, really nice hedge for any kind of tariff wars concerns in the US. So that's why we have introduced it back into portfolios over the quarter. And we'll keep a very close eye as to what's going on there. But more than happy if people review these slides after the call to people to come back and ask questions on this. More than happy. In fact, I invite them. Where are we at the moment? This was a slide that I felt really sorry for everyone about. We're actually, by and large, hugging pretty close to benchmark at the moment. I know it says that on money market, so that's almost cash equivalent. There, I know it says that we are underweight there, but that's because the asset-backed securities sits in the alternative space. On a net basis, we certainly have a reasonable amount of equivalence there. The one place that we don't like at the moment is North American fixed interest in the corporate space and high yield, just very, very expensive. As a result, we prefer in Europe, the spreads are just a bit more favorable going on there. Otherwise, there isn't an awful lot remarkable in portfolios at the moment, just staying a little bit safe compared to benchmark and relying more on our active holdings. But places that we might show a little bit more interest in, as I said, was infrastructure, which will possibly sit to again under alternatives, but also possibly moving a bit more into European equities from US. US equities are very expensive again at the moment, whereas although European equities are certainly not cheap, they're a bit more likely to have upwards earnings looking very, very good over the next couple of years. So a bit more positive going on there. And I think that kind of brings me to it for the quarter. 35 minutes, so try to keep it as concise as possible, but certainly ping over questions if there are any.
Thanks, Sam. That was a great presentation. We haven't got any questions at the moment. I'll leave a couple of minutes just to get any last minute ones in. Otherwise, we will obviously be having another update from Sam next quarter. There will also be a short survey that I'm going to pop up in a moment as well. So if you do have 30 seconds of time just to leave some feedback, then that will be greatly appreciated. There's also a section in there if there's anything that you want to see looked at more in depth or covered off in the next presentation, then do leave those ideas as well. I'm sure Sam will take them on board. And if you do think of any questions post-presentation, then also please get in touch. Let me pop that up now. And then for all of those who do regularly join our webinars, just let you know that if you do sign up to them and for any reason you can't attend in the future, you will also receive a copy of the slides and the recording. So just make sure it's always worth just signing up for the webinars when those invites come through. Oh, Sam, we have just had a quick question come through if you're happy to answer it. USD versus GBP pound is down about 12% this year. How much of the GBP growth is due to exchange rate and how much is due to fundamental growth?
Yeah, sure. So I think what was expected at the beginning of this year was people were expecting that UK rates were going to fall far quicker than in the US. And obviously that has not occurred. So kind of like the carry trade. So what that is there is the difference between what you get holding your cash in the bank, say in UK versus the US. There's very little there. So I think that has had quite an effect. The other factor as well is, yeah, as you said, you know, US growth forecasts have slowed down compared to, you know, UK. UK is a strange one. It just seems to love trading, not trading. It loves to, UK economy growth seems to love bumbling along in this range and not moving a huge amount. So the stability there has been going along. It's the other factor as well is that sterling acts as a more high beta or, you know, a more risky kind of currency equivalent to the euro in some ways. It has a high degree of correlation off the euro, but is more volatile. And that, with all the upgrades that have been going on in Europe over the last 6-7 months, has meant that sterling has rallied quite well along with it, off the back of expectations of, you know, cross-border trade and all of that kind of element. However, as I said, you know, dollar has been on its way down quite a bit now by itself. So it's both factors, dollar going down, UK and Europe going up, the two together have ended up with this. However, we've had the call that I've been on, I've been expecting that to go, you know, pound into the 140s over the next 12 months. So even when it hit 138 a little while ago, you could have taken the opportunity to reduce a degree of the currency hedge that we have there. It's currently about 20% on US equity. Decided to keep it because trying to call when on the short-term trends where things go is quite often how you end up losing money. So holding that in the expectation that it will end up through into the 140s in the next 12 to 18 months.
Perfect. Thanks, Sam. No, we've not had any other questions. So, like I said, I'll pop the show back up and we will catch you at the next presentation. Thanks, everyone.
Thank you all for joining.